Hello folks, and welcome to today's webinar, which is looking at some of the key benefits of in-house banking solutions. My name is Justin Callaghan. I'm the CEO of a company called FTI Treasury, and we've been providing in-house banking and treasury outsourcing solutions to multinational corporates for over 30 years. So today we're just going to walk through at a very high level some of the key benefits that we've seen accrue to our clients over the years. I should say that we're focused very much on the treasury aspects of in-house banking today. So we won't really be looking at the AP and AR side of things, although we can certainly discuss how you can layer them in, but we would refer to them more as the shared services side of the house as opposed to the treasury side of the house. So in terms of the structure of today, we're going to have a pretty short presentation in reality, where we're just going to try to paint the picture of what is trying to be achieved from an in-house bank in general, and then some of the benefits of implementing those structures as we've seen them over the years. We'll quickly touch on some of the technology that's used to support the in-house bank. Obviously, there's been significant changes in the ability of technology to facilitate delivery of these services and the efficiencies that an in-house bank can bring. And then we're going to look at how you can resource your in-house bank. And in reality, most people look at the choice of either outsourcing that to a third party or doing it themselves within their own organization. And then importantly, we're going to just have a Q&A. So I would hope that the presentation will take us up to around about 20 past the hour, and then we can leave 10 to 15 minutes for Q&A towards the end of the session. Okay, so let's kick off. Before I suppose we look at some of the more detailed benefits, I guess it's a good idea to look at some of the big picture common objectives that people often set out to obtain when looking at an in-house banking solution for their organization. And really these fall into several different common categories. The overriding objective tends to be obviously the requirement to try to reduce risk and reduce cost for an organization. And when we look at that, we see probably 5 or 6 different areas where that can be obtained. First of all, we're looking to centralize. So obviously, using an in-house bank allows you to put a lot of your organization-wide treasury activities in one entity. And when we say centralize, I mean, that can be on any balance sheet anywhere in the world. We here at FTI Treasury manage in-house banks that have balance sheets in the US, in the UK, Sweden, Switzerland, Ireland. So really where the in-house bank is located from a jurisdictional perspective is somewhat irrelevant. It's more the concept of centralization that becomes important. Obviously, given the name, the in-house bank, what we're really trying to do is ensure that we have efficient cash and working capital structures in place. And again, by consolidating them to a single environment, it allows us to do things that will be much more difficult if they were done on a disparate basis around any particular organization. Having looked at some of those sort of asset centralizations, we also need to look at some of the process controls that we can put in place. And obviously by implementing standardized treasury processes across the organization via the in-house bank, it brings a lot more control centrally, both from terms of risk and in terms of management of cash. Which brings us on to the next common key objective, which is risk management. And we can really reduce treasury risk significantly via an in-house bank across all sorts of different risk measurements, be that counterparty risk, FX risk, interest rate risk, or even just process and control risk. And then finally, control and visibility, which has become more and more important, I suppose, in recent years in terms of the requirement to understand what our group-wide exposures are, to be able to manage them on a more centralized and more efficient basis, and to understand where our cash is effectively, particularly when we're looking at global multinational businesses, with operations in many different countries. So generally speaking, those are sort of the key objectives that we would see corporates looking to achieve when they're trying to establish an in-house bank. So how are they achieved, and what are the benefits of an in-house bank? Well, look, we've identified 5 key benefits here. but they're actually multifold. And when you talk to any particular client, we find that they often have very different views as to what the benefits are. So we've tried to sort of pick on, I suppose, some of the key ones that we see recurring. But again, it's really down to the organization itself and what they want to house in their in-house bank structure. The ones that we're going to focus in on are firstly liquidity management, then intercompany lending, FX risk, then netting, and then visibility. So if you look at number one, liquidity management, what are we trying to do here? So we're trying to centralize and automate cash and liquidity management using an in-house banking structure. Any of you who have gone through the pain of making those phone calls at month end to Australia or Japan or Spain or whatever, begging them to centralize cash to you will understand the benefit of having an automated cash and liquidity structure in place. And really by using a single entity, a single balance sheet, it facilitates that a lot more. So we can consolidate our group-wide daily cash flows on a single balance sheet and therefore maximize the efficiency of our cash. How do we do that? Well, automating is obviously the key, and many of you will be aware of the various different liquidity structures that are available and provided by our banks. But you know, by placing them all on a centralized platform, it does allow us to really get the maximum benefit out of, you know, whether it's a zero balancing arrangement, targeting arrangement, multi-currency notional pool, or even multi-bank pooling solutions. It means that we're really getting that offset from long and short balances, and making sure that cash is centralized on a regular, if not daily basis, which allows us to control and manage the group-wide cash. We can get maximum efficiencies in terms of paying down debt on a central basis, and we can also look after the daily management of cash flows in all of the different currencies around your group. So that's number one, liquidity management. Number two, intercompany loans very much goes hand in hand, obviously, with liquidity management, but the efficient management and administration of intercompany funding is really a cornerstone of an in-house banking structure. Again, any of you who know the pain of trying to manage intercompany loans where Mexico has lent to Spain and Spain has lent to Germany, and there's a web of mess that's badly managed, will understand the sort of efficiencies that can be brought by housing them all on a single balance sheet. So what are those efficiencies? Well, first of all, we have the obvious efficiency of asset efficiency. So we can gain the maximum benefit by offsetting our long and short positions in multiple currencies across the organization. It allows us to really manage most, if not all, of our external debt centrally, which means that you can reduce any risk to local drawings or badly negotiated facilities at a local level. And at the end of the day, it allows us to reduce our external interest expense by having a single depository entity where we can mop up all of the available cash and do our intercompany lending in an efficient manner. The second efficiencies are administration efficiency. So we can standardize the intercompany borrowing process, and that includes everything from documentation across interest application and the intercompany settlement process. In general, what we're trying to do is ensure that the in-house bank allows the Treasury function to control and manage all of the intercompany loans within the group, thus reducing exposure to local bank counterparties, and indeed ensuring that borrowing limits and levels at a local operating entity are adhered to. So that's number two, intercompany loans. Number three, next benefit of in-house banking solutions is FX risk. Look, we again all know the difficulties that can be caused when local entities or local subsidiaries try to manage FX risk on their own. It can often be very expensive and often badly managed in reality, because the people just don't have the time or the skill set in order to look at it in an efficient way. So by managing FX risk on a consolidated basis, we can reduce down, obviously, all of our exposures, and also importantly, we can use best execution to ensure that we're getting best pricing. So from a consolidated perspective, we're looking to manage balance sheet exposures by netting them off, and also importantly, to be able to look at efficient cash flow hedge strategies. So by looking at both the balance sheet exposures and hedging them, and looking at the cash flow hedging strategies on a consolidated basis, we can get the maximum benefit for the group on a group-wide basis. Very importantly, by using an in-house bank structure, it allows you to obviously put in place best execution, be that using a multi-bank online trading system, or just using standard phone trading with your range of counterparty banks. The important thing is that you're getting competitive trading with key relationship banks. So you're driving your FX to the banks that you want it to be with, and also you're able to consolidate down the risks so that you're minimizing the nominal value of FX that you're undertaking. Again, it's all about getting control and management, gaining control and visibility over the group-wide FX and the hedging levels, and executing them in a best practice environment. So that's number 3, FX risk. Number 4, netting. Again, management and control of intercompany balances using an intercompany netting solution, and ensuring that there's internal payments are effectively managed and settled on a regular basis. So anybody who's familiar with netting systems will know that they are fantastic for simplifying the balance sheet. So what we're able to do is clear out all of those intercompany trade balances that might exist on a web basis between all of the various different operating entities around your organization, and we can effectively replace them with a single balance in base currency with each operating entity and the in-house bank. So effectively simplifying the balance sheet of the group and deflating the balance sheet of the group. It also obviously reduces risk by eliminating any FX associated with intercompany payables and receivables. And in some clients, we see that the intercompany element of FX exposures can be up to 60% of the overall gross exposure within that company. So by, as you say, continuously paying down these intercompany outstanding balances and replacing them with a single base currency loan from the in-house bank, it allows us to gain control over our intercompany cash flows. And again, we're ensuring that we're getting best execution of FX trades associated with these flows. Number 5 is visibility, and this is probably been one of the more focused on areas of the in-house bank in the last number of years, with the increased requirement to understand where cash is and to be able to report on a real-time basis in terms of cash. So what we're trying to do here is 2 things really. It's get visibility of group cash, know where your cash is on a real-time basis, and importantly to be able to manage a group-wide forecasting system efficiently. The use of an in-house bank as a single platform allows you to centralize reporting of bank balances, and that goes hand in hand with some of the liquidity management tools that we talked about earlier on. And indeed, then this allows you to implement a standardized forecasting approach, preferably using a bespoke forecasting software. The beauty, I suppose, of an in-house bank is that you do have access to a lot of data. You will have all of your treasury flow data, all of the intercompany borrowing flows, all of the netting flows and intercompany netting flows, as well as details of most, if not all, of the bank balances from the group. So by consolidating them into a single system and layering on the AP and AR information from your ERP system, it allows you to get to a very standardized and automated approach to cash forecasting. And that's important, I guess, the integration and the automation of that flow, because as we all know, forecasting using sort of spreadsheets and trying to hammer data in and collect data from around the world is very hit and miss and very difficult to ascertain, even when you look at variance analysis, how accurate that forecasting actually was. So that's it. That's the 5 key benefits that we would outline in terms of implementing an in-house banking structure. And we see people putting all of those processes within an in-house banking structure, some of them, and often, it's a situation where it's organic. So someone might choose to, for instance, just try to consolidate all of their intercompany lending as a starting point, then they'll layer in an automated liquidity management system, and then they'll add maybe netting and visibility as a later phase. So it's not an all or nothing. Lots of people go for the big bang approach, but also others just go for the gently approach and layer in processes in order to get the benefits on an incremental basis. I could briefly, very briefly talk about some of the technology used in in-house bank structures. And the reason I say briefly is that really we could spend a couple of hours just discussing this topic. There's such a wide range of available solutions in the market. And importantly, again, it's all about integration, data integration, flow integration, and process control integration. So rather than looking at one big system that might do everything, we generally would look at the best in class in some of the more key areas and more key processes, and then look to integrate them using SFTP and other interfaces, API, etc. At a very high level, the sort of structure we would look to implement in terms of an overall sort of technology ecosystem revolves around the in-house bank having management control and implementation control over a number of key systems, and those key systems we've listed here. So first of all, as a central database to manage all of the trades and all the intercompany loans, any flows that are coming from zero balancing arrangements, et cetera, a fairly fundamental and integral central part of any technology ecosystem for an in-house bank is the treasury management system itself. And that generally acts as the centralized database which feeds off and feeds to all of the other systems. Secondly, the netting system, fairly self-evident, but required really to implement an efficient netting process, allowing for auto reconciliation, cash application, and also just the standard netting function itself. We also see forecasting systems, again, the integration of those with the netting system, treasury management system, and indeed the ERP systems is essential really in terms of being able to produce an efficient forecasting system. And then we have things like FX trading systems, FXall 360T, market feeds, whether you use Bloomberg, Reuters, importantly EV banking platforms, whether you have a bank agnostic platform like Swift or rely on some of the larger banks to provide you with proprietary banking platforms. They obviously are a central source of information in terms of bank balances and flows. And then finally, obviously, we need to ensure that all of this treasury transaction data and accounting data is getting into the ERP system at the end of the day for a consolidated view. So our general environment would be to manage all of the treasury systems and then feed an accounting file into either the centralized accounting system or the centralized ERP system, and likewise to gain any trading data that we need in terms of AP or AR data for netting and forecasting out of the ERP system on an API or SFTP basis and into the netting and forecasting system. So a lot of integration really helps in terms of having an efficient in-house bank setup. Just as at a high level, the technology partners that we use is our treasury management system comes from CGI Twin, and we've been working with them for a number of years and have developed a lot of great integration and solutions around in-house banking with them. We use CoProcess as our netting system. Again, we've worked with them a lot in terms of developing their system and making sure that it fits for customer requirements. We use Dimension Liquidity for cash forecasting, and then we use UiPath for our robotic process automation. So, sitting over, I guess, all of the other systems is UiPath, which is really making for efficient processes, ensuring that data is collected on an efficient basis and available to the team when they need it in a timely fashion to allow them to go about their daily requirements from a treasury perspective. So you've established an in-house bank, and now you're wondering how you're going to manage it, and often this is a chicken and egg situation. So people are kind of wary of trying to establish an in-house bank because they're concerned, I guess, about how they will manage it when it's up and running. Generally, I suppose the choice that we see clients making is either to outsource to a third-party provider such as FTI Treasury, or to do it themselves internally. So from an outsourcing perspective, we look at the pros. It's very cost effective. We can obviously gain economies of scale because we provide these services to lots of different clients, which means that we can have a team of resources that is spread across a number of different clients. And that can result in a very cost-effective solution for an in-house banking structure. The other obvious pro is that you have access to expertise and full system solutions. So, we've done this lots of times, so we're able to do it quickly. The team know exactly what the requirements are and what works best. We're lucky to have learned from some of the best companies in the world. Also, there is a very defined control environment. We here at FTI hold an SSAE SOC 1 audited environment, which we get every year. So, you can place a lot of reliance on the strict controls that are in place. And then really importantly, the outsourced solutions tend to be very easy and quick to implement. So you can throw a lot of that implementation effort back on the third party who's providing services for you. Scalable and flexible, so they can grow with you as you wish to grow either processes or in size or jurisdictions. And then there's resource continuity because there's a bigger team effectively. You have access to a wider cross-trained team of experts who can slot in and out and ensure that there's a continuation of service. The cons that people generally would quote for an outsourced solution are that you would decrease the control that you have effectively over the processes. You can develop a dependency on the service provider, and then you have another relationship to manage. But we would argue that all of these cons are easily mitigated if you choose the right outsourcing provider and the right outsourcing environment indeed. On the insourcing side of the house, so the main pro that people will quote is that you maintain total control, and some people that suits them. They find that is the environment in which they wish to operate. But if that's what you want, then it comes with a cost, and it's both a financial cost and a risk cost. The first cost is systems. I mean, you have to invest proprietarily in an ecosystem in order to be able to provide all of the necessary processes. And indeed, importantly, you have to also invest in getting those integrated with each other to the extent that they need to be. Secondly, it can be difficult to resource. As we all know, treasury resourcing is, from a personnel perspective, is reasonably difficult on a global basis. And these particular skills can be difficult to find and, importantly, difficult to hold on to. The number of full-time employees required to achieve segregation can often put people off in-housing as well. Really, in reality, you're probably going to need anywhere between 3 and 5 full-time employees to be able to achieve the level of segregation that will be expected in most PLCs. And then we've talked about unstable resource continuity. When people leave, if you've insourced this, it leaves a big gap. Whereas if someone leaves an outsourcing provider, it's much smaller because there's a wider team that can take up the slack. And then finally, and I wouldn't underestimate this one, it can be very difficult and expensive to implement on an internal basis. So look, we've got skin in the game. We think outsourcing is the way forward when you're looking at some of these in-house banks, and certainly our clients would agree with us on that. But that's an assessment that each and every organisation has to make on their own. So, in summary, why establish an in-house bank? Well, first of all, if we think back to some of those common objectives, we want to gain further control over our organisation-wide treasury processes and banking. It's a very efficient way to manage your working capital, no matter how you cut and dice it. If you have the ability to consolidate and centralize cash and risk, then you're in a really good space from a working capital perspective. It allows us to manage risk on a more consolidated basis, and importantly, it allows us to obtain information that we need to make treasury decisions. Having all of those things centralized in a single in-house banking environment really are amazing benefits for any organization. Why outsource? Well, look, we've run through some of the pros, but really there's a value proposition there whereby you can gain experienced resources in a controlled environment in a value for money way, and also you get the out-of-the-box technology ecosystem with quick and easy implementation. So there are very significant reasons to consider that as a way forward. So look, we've run through that pretty quickly. I think we've got about five or so minutes left for questions. So if anybody has any questions, please feel free to type them into the little questions box there, and we can field them. Okay, so there's one there. What are some of the pitfalls associated with establishing an in-house bank? I suppose it's a maybe a bit of it's a question that people probably raise a lot when they embark on one of these sort of projects. We would say that probably the essential thing is to get shareholder buy-in at the start, sponsorship at a senior level in the finance department, and also buy-in from tax, accounting, and AP and AR are really essential. So if you can bring them on the journey with you, they will see the benefits that establishing an in-house bank will bring to them. And there's lots of benefits that go throughout the organization in terms of making things like reconciliation easier for accountants, having automated accounting output for the accountants from the systems, and then the netting, making the AP and AR, internal AP and AR processes a lot simpler. So if you can bring those stakeholders with you, you'll certainly avoid most of the pitfalls. I'd say the other potential pitfall is that people can fall into is not having a clear vision of what they want their in-house bank to be. So if you can start out saying, look, these are the objectives, a bit like what we've outlined here in this brief presentation, and say how you can get there and point out the benefits, both monetarily, you can do financial and business analysis in order to come up with the financial benefits that would accrue to an organization, and importantly, the process efficiencies and the risk reduction efficiencies. Again, you can sidestep probably a lot of the pitfalls using clear communication with the stakeholders and having a vision of where you want to be at the end state. Another maybe another question. Okay, so typically, how long would you expect an in-house bank setup to take? So there's a touch of how long is a piece of string on this, because it depends on what you wish to house within your in-house bank. Typically, we would say to clients who are onboarding with us that it's going to take about 8 to 12 weeks to implement the in-house bank structure. Now, we say that, but obviously one of the key elements is whether or not you already have an automated liquidity structure in place with any of your banking partners. So if you're trying to implement an automated liquidity structure, a zero balancing structure, notional pooling structure, or even a multi-bank pooling structure, then that would be a contingency. So often what we would see is clients of ours, we would onboard them and we would onboard all of their netting requirements, all of their intercompany lending requirements, help them with forecasting and getting cash visibility. And at the same time, we would help them implement a liquidity structure. But if you talk to your bank, they'll probably quote you 3 to 6 months in order to implement a structure of that type. So there can be contingencies, but generally we would say to clients in the 8 to 12 week region for the actual infrastructure to be set up. Okay, folks, just conscious that our short session is coming to an end. So I'm having sorry, the questions are coming in a bit thick and fast at the moment. So I tell you what, if anybody has questions that we didn't get a chance to answer, please feel very free to contact me either by email or phone, and I'll happily come back to you with a more detailed response. Thank you very much for attending today. I know it's been a very short session and it's quite high level. Really, it's just trying to open up people's thought processes in terms to what you could achieve with an in-house bank. If anybody would like to contact me directly, please feel very free to do so. If you have any more detailed or technical questions, we would happily answer them. Alternatively, please visit our website where you can get lots of information on in-house banking and what we do. And indeed, sign up for our newsletter where we can keep you up to date with what's happening in the in-house banking and outsourcing world. So listen, thank you all very much for joining today, and we'll hopefully talk to you all soon.